So according to the ONS, the average pension wealth in the UK for those people who have actually got pension wealth was about £145,000. So if you've got £200,000 in your pension pot, you're doing better than most. But just do the maths. How long is that likely to last you in your retirement? 5 years, 10 years, 15 years? But the ONS also says that the average man will now live to age 79 and the average woman is likely to live to age 83. So if you retire at age 67, there's potentially 15 to 20 years and more that your pension needs to keep on paying you without running out. And that's where so many people are starting to get caught out. They think they've made it and they skip some very crucial steps that are going to determine whether the pension lasts you 5 years or 25 years. So if you want the money to last throughout your retirement, you could draw down between £8,000 and £10,000 a year, and that works out to be roughly between £650 and £850 a month. And that's before allowing for any income tax or accounting for inflation, of course. So the system is built to make you feel secure, but not to actually be secure. So in this week's video, I'm going to show what those steps actually are and how you can take control of your retirement before you start even drawing a single penny. Because if you wait until your final pension statement, it's likely to be already too late. If you're new to the channel, a very, very warm welcome. Hi, my name's Simon, and I'm a chartered financial planner with decades of experience helping hundreds of clients as well as their families plan ahead with confidence by keeping a lot more of what they've earned. So about 6 months ago, we published this video about how much income you can take from an average pension of £145,900 that went viral with over 175,000 views and about 650 comments. So the main theme that was running through the comments section was that a £200,000 pension should be enough when combined with a state pension. And that's why we've put together this video about some crucial steps that you need to think about that most people either aren't aware of or just don't bother doing. So if you think that a pension pot of £200,000 means you're safe, in inverted commas, in retirement, you might need to look at this again. So having worked with literally hundreds of clients, the truth is that in many cases, £200,000 in a pension may not stretch nearly as far as you hope or you might expect it to. And that's especially true if you skip some very crucial basic steps that many savers seem to overlook. So let's start with a very straightforward fact. Overall life expectancy in the UK is increasing. Now, of course, there's going to be areas in the UK where life expectancy is linked to where you live, but the ONS says that from age 67 years old, the average man can expect to live a further 19 years and the average woman a further 21 years. So in other words, if you retire at the state pension age of 67, your pension pot may need to last you until your mid-80s and possibly even into your 90s, especially if you're in good health. Now that seems to me to be an awful long time to rely on income from your savings. Let's have a look at that £200,000 pension again. Now here's some charts from the FCA, and they show that about 90% of pensions are accessed via the drawdown route compared to about 10% via the annuity route. Now, as you can see at the very bottom of the chart, there's been an uptick recently in annuities, and that's because they're now giving some of the highest income that they have done in the last 15 years. Now, in this chart, you can see that those who've got up to £250,000 in their pension overwhelmingly prefer to go down the income drawdown route. And in this chart, you can clearly see where the problem lies in the blue bars. Now, people with pension values of up to £250,000 have been drawing them down at a rate of 8% or more, and that could mean that the money is going to run out a lot sooner than expected. So if you've got £200,000 in your pension, you're doing better than most are, as according to the ONS at least, the average pension value is closer to around £145,000. But being better than average doesn't necessarily mean financially secure. Now, here's some rules of thumb to make all these calculations just a little bit easier. You can estimate your annual income and multiply that by 25. You can calculate your monthly outgoings and multiply those by 300. Or you can also take your final salary and multiply that by 10. So let's now work backwards using those rule of thumb calculations with a £200,000 pension. That means you're going to have an annual income of about £8,000 a year. It'll cover monthly outgoings of about £650, or it's going to support a salary pre-retirement of about £20,000 a year. Now, if you draw about £10,000 a year using a 5% withdrawal rate and have modest investment returns, your pension pot could last roughly 20 years or so, and maybe a little bit more, but also a little bit less if financial markets are volatile or if inflation spikes. Now, a lot of people in the comments section said that they were tempted by high income or high yield funds, which are essentially funds that project an income of 6%, 7%, or even 8% annual yields. Now, they may sound like a perfect solution for higher income, but with less drawdown pressure and certainly less stress. But of course, with all these things, there's a catch. Now, higher yields often come from being invested in riskier underlying assets, things like emerging market bonds, smaller company shares, infrastructure, or even private credit. Now, these funds may provide attractive income now, but that income isn't guaranteed, and the capital value can swing hard, especially in down markets. In fact, research by Morningstar back in 2023 found that many income funds with yields above 6% had significantly higher volatility. This means that your pension pot could take a painful hit right before your retirement or in the early years of retirement when you can least afford it. Now, of course, if you're drawing income whilst the fund value is falling, you're effectively locking in losses that can permanently shrink your pension fund, making it a lot harder to recover over the longer term. Now, that's not to say that income funds are bad, of course. In fact, far from it. They can be part of a sensible drawdown plan if you understand the risks, you diversify properly, and you don't just chase yields blindly. Now, a mix of dividend-paying equities, bond funds, and reliable cash holdings can create a smoother, more sustainable income retirement stream, which is sustainable for the long term. Now, in fact, I use some of these as part of my retirement plan as well. And here's a snapshot of the performance of one of the income funds that I've used over the last 5 years. And if you think it might well help and you want to know which one it is, then just type fund into the comments below. Now, that being said, too many people think that high yield equals safe income. It doesn't. Far from it. And I still remember the carnage that happened in 2022. In fact, you can see in this chart from Bloomberg, the messy green lines are the returns from bonds from 1990 to 2022. But as you can see in the very dark green line at the bottom, the absolute outlier, that bond returns can be absolutely brutal. Now, don't forget, a pension pot is not just a slot machine that pays out forever. It has to have a balance between growth, stability, and sustainability as well. So if you're finding value in this video about the steps that you need to follow if you've got a £200 pension, then please hit the like button and subscribe to the channel. And don't forget the notification bell either, so you don't miss any of this regular content. Now, once you've done that, let me ask you a very simple question. So would you rather enjoy spending your money early in retirement and have the risk of it running out, or live cautiously and perhaps not spend all of what you've saved? Let me know in the comments. Sorry to interrupt the video. Over the last year or so, many of you have reached out asking if we can help with solving some specific problems, particularly around your retirement plans. And I've spoken to a lot of you personally on Teams. The great news is that we can now scale this properly and efficiently, but we're going to need to cap this at just 90 new clients throughout 2026. And that's going to allow us to keep it personal, intimate, and obviously make the recommendations and give advice of the very highest quality. So please follow the link on the channel and we're going to be in touch with you very quickly. If you're not ready to take that step just yet, there's no problem at all. You can register an interest and join our newsletter. So it's going to be tempting to assume, rightly or wrongly, that you're going to spend less in retirement. But in truth, many people maintain their spending patterns or even increase their spending, especially in the early years, on travel, new hobbies, and maybe medical costs as well. So make sure you use a realistic budget planner, or even take out about 3 months worth of bank statements so you actually know what you're really spending your money on. Now, the FCA is very concerned that withdrawal rates are closer to 8% rather than the more traditional 4% rule, where you withdraw 4% of your pot each year and then increase it and adjust it by inflation every year. Now, this rule of thumb is a little bit outdated now for many reasons, and I've done videos on this subject before, but you need to make sure that your money isn't going to run out too quickly. Now, you might just assume that taking your tax-free sum, that's job done, and yes, you can usually take 25% of your pension pot tax-free, but remember, the rest of the drawdowns that you take are going to be taxable at your highest rate. And don't forget investment fees, fund charges, platform charges, inflation, as all this is going to erode your pension fund and chip away at your future fund value as well. So as you approach retirement, you should consider amending or changing, adapting or evolving your investment strategy. If your pot has got £200,000 in it and you leave it all in high risk growth funds, you could take a big hit, just as you need to switch to long-term stability. Now, many workplace pensions offer lifestyling or automatic de-risking with their investments, but you need to check where your fund is invested, because these funds and the way they're invested is changing fast. And skipping this step helps absolutely no one. And finally, don't assume that your pension pot is going to be your only income. You're going to need to know where the state pension fits in. Are you going to work part-time because you need to or because you want to? You need to think about the uncomfortable thought of an inheritance or property or perhaps other savings. And what about care costs later in your retirement, or perhaps some unexpected health expenses? Now, if you're looking some or all of these factors, it means that your £200,000 pension pot might have to work an awful lot harder for you than perhaps it should. Now, these aren't the only factors to consider. So I've linked a further 2 videos in this series about pension income drawdown for beginners and another on whether the state pension still is fit for purpose. Thank you for watching to the very end and for your time, for your patience as always, and we'll see you all again next week.